Hello everyone and welcome. In this video, I'm going to go through some of the ICT concepts and give you my interpretation of them. First of all, this is in no way an exhaustive list of all ICT concepts, nor may my interpretation reflect exactly what ICT intended. As I mentioned in my previous intro video, most of the things you learn depend on your point of view. That is not to say that ICT concepts are not objective. They are. But not all of his concepts are simple, and as such leaves room for interpretation. First, let's talk about concepts and indicators in general and why they are important. In my previous video, I mentioned reading the signs like a hunter to get a view about your prey, what it is and where it is heading, so you can intercept and snipe it. The prey, in this case, is the algorithms which are steering the market, and just like any algorithm, they leave repeatable signs that you can identify. And that is exactly what these concepts and indicators are. They leave signs, and it is up to you to learn these signs and filter out the ones that are significant. Much like hunting, no signs will look exactly like the other, but there are identifying aspects. A bear track will not look the same as another bear track, but it has commonalities which shows that it is a bear and not a deer. So you need to isolate the tracks that you want to pursue from all other signs so you can effectively track it. Also, you need to put the tracks that you find in a narrative. A narrative is your view on where the market will go, and indicators and concepts is how it will get there. They help you both build your narrative and see if the market is following it. So you need to identify which signs in the market that fits your narrative. And this, I believe, is one of the most important aspects of trading analysis. You cannot just blindly look at indicators and get swayed by their every twist and turn. Rather, you need to first create your narrative, and then see if the signals you get from indicators and concepts fit within that narrative. If it doesn't, then you need to simply either walk away or keep reading the market. What you should not do is to trade when the market is not in sync with your narrative. That would be the same as a hunter stalking a prey without knowing where it is headed and when it will reach there. But more on building a narrative later. But for now, let's talk about the first ICT concept, and in my opinion, the simplest one, and that is the fair value gap. The fair value gap, or in short FVG, is when the market goes in a direction inefficiently. What that means is that it has gone up or down relatively quickly, and as such not allowing the shorts to efficiently trade with the longs or vice versa. It is a three-candlestick pattern formed by the lows and highs of the two candlesticks on either side. The following illustrates what it looks like on a real chart. Here we see three bullish candlesticks with the largest in the middle, forming the gap by using the low wick of the previous candlestick and the high of the wick of the following candlestick. The midpoint of this gap is also marked out as it can be significant. Please excuse the errors in the annotations. Next up, we have the bullish variant of the fair value gap. As before, the middle candle flanked on both sides is what is creating the gap by the lows and highs of the surrounding candlesticks, and also the midpoint marked out. And this time, we are going to see how the market reacts to this area. Observe how, with great precision, it reacts to the midpoint, showing signs that it will continue going up. Continuing further, we see that the market again trades down into it, first with a long wick and then with the bottoms of the candlesticks. This is what ICT says is the wicks doing the damage, but the bot is showing that it respects the gap by staying inside of it. What this means is that the wicks are allowed to go outside of the gap, taking out any potential sell or buy stops. But the bot is indicating that it wants to continue going up. And jumping ahead, we see that this is exactly what has happened. However, it is important to note that indicators, such as fair value gaps, are only valid if it fits within your narrative. Because, as you can see in this chart, fair value gaps form all the time, but they only make sense if it fits within what you expect the market to go to. Finally, I would like to mention the inverted fair value gap. This is a fair value gap that has been traded to but is still valid in the inverted form. Here we see initially a bearish fair value gap forming. However, it is later completely rebalanced. But does that invalidate it? In this case, that is actually not true. Because observe how the market later on traded into this area, which now is acting as support for it to continue going up. Pay extra attention to the preciseness to how it respected the midpoint, as these kind of details are important for when reading the market. So to summarize, there are three types of fair value gaps. Bearish fair value gap, also known as a SIBI, short for sell-side imbalance, buy-side inefficiency. It tends to act as resistance, pushing markets lower. Then we have the bullish fair value gap, also known as BISI, short for buy-side imbalance, sell-side inefficiency. It tends to act as support, pushing markets higher. And inverted fair value gap, which is a fair value gap that has been traded through and is now acting as the opposite of its original form. They form all the time, so you need to decipher which are relevant to your narrative and which are to be ignored. The reaction to the midpoint of the gap is usually a good indicator, and keep in mind that the wicks do the damage, but the bodies tell the real story. And that is all for this video. I hope you found it useful. And if you did, then please like and subscribe, as the next video I will talk about the most important concepts, and that is liquidity. So take care and see you the next time.